Hey, take a look at this. This is a graph of the top 100 British companies' performance over the last 5 years. And next I'm going to show you the American equivalent. You've probably noticed that the British stock market has done much worse than the American equivalent over the last 5 years, and in particular during COVID. The reason for this is that while the US stock market is dominated by big tech, which have done extraordinarily well over the last 5 years, such as Amazon, Facebook, or Nvidia, the UK stock market is dominated by slowly declining dinosaurs like British American Tobacco, Royal Dutch Shell, or British Petroleum. The US tech advantage was compounded by COVID-19, which drove even more consumers into tech companies' arms. While their competitors were hindered, they were still able to operate effectively. When you add in the uncertainty that Brexit has brought to the UK economy and stock market as a whole, and the different fiscal policies between the UK and USA, it's easy to understand why the UK has underperformed over the last 5 years. In this video, I'm going to take a look at all these factors to explain to you why the UK has underperformed and why I think it's going to continue to underperform in the future. Take a look at this. On the left-hand side, we have the top 20 companies related to the UK and the sector they relate to. On the right-hand side, we have the same for the US. You'll notice a few things. First of all, the US has 10 out of 20 of those top 20 companies being tech-related. The UK has none. The UK is chock full of oil, gas, utility, and retail companies. Now, maybe there isn't anything wrong with them, but they're certainly not rapidly growing industries. And you can really see this if you look at the top few companies. Go on Google and Google the returns for top few companies in each. You'll notice companies like Amazon, Facebook, Apple, they've returned hundreds of percent over the last 5 to 10 years. You won't find the same for the UK companies. You can see these sort of trends in the wider stock markets across the world as well. If you look at the Brazil stock market, it's so heavily dependent on oil that the recent decline in oil has led to it underperforming world indices considerably. These are ARK's big ideas for 2020. ARK Investments, a fund that's massively outperformed the average over the last few years. They like to invest into future technologies early at a massive discount. They do this by successfully predicting what technologies are going to be important for the future. And much like an investment fund, a country has to do the same. If a country can't predict and prepare its economy to support these future technologies, then it won't do well. A perfect example of this is China. China has purposely restructured their economy to support businesses of the future. You've probably heard of NIO, the Chinese electrical car company. You've probably heard of TikTok, the huge social media organization which came from China. And you've probably heard of huge games like League of Legends, which are partly owned by Tencent in China. China is always moving their economy to where the ball is going and not where it is now. So for example, in the past few years, they subsidized solar energy and electrical vehicle makers. And now they're probably going to be subsidizing AI, automation, deep learning, these sort of areas to support their economy in the future. On the other hand, if you look at countries like Venezuela or Brazil, they're stuck in very much old industries like oil, and that's damaging their long-term prospects. As you can see from the UK's top 20 companies at the moment, none of these are these huge future growth companies. The reason for this is that the government hasn't sufficiently pushed for or supported these future industries, and until it does, the UK stock market will continue to lag behind its American counterpart. One equalizer between the US and UK stock market returns that we haven't mentioned so far is the dividends paid out. The UK pays far higher dividends at around 4% compared to the US's 1%. Now, even if you include those, the all-market return of the US is far higher. Look at the graph on the screen. You can see just before COVID happened, the US stock market return over the last 10 years was about 400%, while the UK's return was about 220%. Now, since COVID, this has got more exemplified due to the factors that we discussed earlier in the video. The US stock market also has a much higher price to earnings than the UK equivalent. The price to earnings ratio is the ratio between the price of a stock and the earnings that the company brings in. If a company has a higher price to earnings ratio, it means that people are paying a premium for the stock now in the expectation that it will have higher earnings in the future. For this reason, you'll see that sectors such as tech have a higher price to earnings ratio in the expectation that they'll grow in the future, as compared to something like oil, which will have a very low price to earnings ratio. But does this mean that it's all priced in? Well, in theory, yes, future growth is priced into stocks. But what we know is that the stock market is incredibly inefficient. And when a stock does well and outperforms what we expect, then you'll get great returns anyhow. For example, Facebook, Amazon, all these companies were obviously massively underpriced in the future based on today's valuations. They've exceeded performance. So if you're looking at these future industries with huge potential growth, then you have huge potential for outperformance. And that's what I expect to see in the US and Chinese stock markets going forward. What about the elephant in the room, Brexit? Well, Brexit undoubtedly brings uncertainty to the UK economy and the companies based here, And investors hate uncertainty. I hate uncertainty. Think of it the same as if you were putting money into a bank. One bank you know is absolutely certain going to be okay in 10 years. You feel comfortable putting your money there. A second bank is undergoing a huge restructuring, aka Brexit. You're going to require something a little extra to put money into it. For example, higher interest rates. Now, this is exactly the same with companies in the UK. Investors will want a higher return for taking on the risk of Brexit, and for this reason, companies' valuations will be slightly lower than what they would have been. Now, my gut says the UK is going to struggle to get good trade deals with either the EU and other large countries. The UK is such a small economy compared to the trading bloc of the EU or compared to the US or China, and if it does get good deals, it's going to take a bit of time. So in the near future, I think the UK is going to have a little bit of a rocky time, and this may reflect in the stock market. However, it's important to distinguish between the UK economy as a whole and the UK stock market. A lot of the companies on the UK stock market are massively multinational, and UK operations are only a small part of their profit. And for this reason, the UK economy and the Ftse 100 are not directly related. However, the uncertainty that Brexit does bring will impact the stock market in some way. In my opinion, Brexit hasn't been a major factor in the UK stock market in the last 5 to 10 years, and it's not going to be a major factor in the next 5 to 10 years. On the screen right now is a graph showing the Ftse 250 against the Ftse 100. The Ftse 250 is the 250 largest companies after the Ftse 100. Now, the Ftse 250 has a far higher average return than the Ftse 100. Over the last 10 years, it's averaged about 11% compared to the Ftse 100's 9%. Now, does this mean that the Ftse 250 is absolutely better than the Ftse 100 and you should invest into it? Well, personally, I would always choose the Ftse 250 over the Ftse 100, and that's because I just don't like the Ftse 100 based on everything I've said in this video. But the Ftse 250 is a lot more volatile, it's higher risk. A lot of these companies are very UK based, for example, Rightmove. And being UK based has its upsides and its downsides. It means you're more in tune with the UK economy. So if Brexit goes well, the Ftse 250 will outperform. But if Brexit goes really poorly, then the Ftse 100 will do a lot better than the Ftse 250, as that international exposure in the Ftse 100 will protect them better. Now, personally, I prefer to invest in international indexes like the US or China. However, the Ftse 250 does have a lot of upside. Right now on the screen is the Ftse 100's performance over the last 1 year. And straight after this, I'm going to put on the S&P 500's performance over the last year. You're probably aware that the Ftse is not even close to the all-time highs that it was before the crash. However, the S&P 500 is now at new all-time highs. Now, what's the reason for this? Well, there's two reasons. First of all, the S&P 500 does have that tech dominance, and tech stocks aren't as impacted by the COVID crash as we discussed earlier. The second part is the quantitative easing that's been put in place by the US government. The US government reacted far more strongly to the COVID crash financially than the UK government did. They've input stimulus checks, which have then been reinvested into the stock market, and they've pumped a lot of money into the economy. However, the quantitative easing isn't the largest factor. It was once again the tech dominance of the US. When I wasn't able to shop for toys or for clothes in the high street, I went to Amazon, and this was echoed by millions of people across the world. And it's the same with entertainment. When I wasn't able to go to the cinema or the bowling alley, I signed up for Netflix, and millions of other people did. We all started driving our money towards stocks on the US index. And not only this, when we saw that happening, we started to invest our money into the US index into these top stocks. And so the demand for these shares skyrocketed, and so did their price. But not only is this just a temporary thing in COVID, it's expected that consumer buying patterns will change forever. People will always be more likely to buy from Amazon than they were before the crash. They'll no longer see the need to go for the high street. And it's the same with entertainment. Many people who have now signed up for Netflix and see the value of it, they're unlikely to unsubscribe. Okay, Braveoak, what are you doing and what should I do? Well, personally, I invest heavily into China and the US. China is always moving to where the ball is going, and the US is already on top of the ball, and I don't see them moving off it in the near future. The US innovation over the last 50 years has been incredible. They've produced Tesla, Nvidia, Amazon, Facebook, Twitter, and even when the creator isn't from America itself, such as Elon Musk, who's from South Africa, people are moving to America because it's the place to create business. When it comes to what you should do, really it's your own decision. Just because I personally believe the Ftse is going to underperform doesn't mean it will. And for many people, investing into your own economy can be a safer and better option. Really, your investment decisions should be made based on your own convictions and your own research. Don't listen to some random guy on the internet. Now, I'll update you on how my portfolio goes in the future, and I really do hope it goes well. I've done a lot of research into it, and so far it's been going pretty well. I think my China investments are up 50% this year, and pretty much everybody knows how well the US stock market has performed over the last 10 years. This is the way. Best of luck. Braveoak out.